Hello and welcome back to my channel, The Billions Investor, your one-stop shop for all things investing and personal finance. Today I'm going to give an overview of what inflation is, why we are currently seeing incredibly high rates of inflation here in the UK, why this is bad for us, and how the UK government may go about tackling this in the future. Now, before I go into this, it's important to note that inflation is a crucial economic concept that affects individuals, businesses and governments. It refers to the general rise in the price of goods and services over a specified period of time, leading to a decrease in purchasing power. Understanding inflation is essential to make informed financial decisions, particularly for us as investors, whether you're a seasoned investor or just starting out. So, why are we currently experiencing high rates of inflation? Well, in short, this can be attributed to several factors, including supply chain disruptions caused by the COVID-19 pandemic. The COVID-19 pandemic has disrupted global supply chains, leading to shortages of certain goods and services. This, in turn, has led to increased demand for these goods, resulting in higher prices. For example, the shortage of computer chips has led to higher prices for electronics such as laptops and smartphones as suppliers compete for limited supplies. The pandemic has also disrupted the production and transportation of goods, leading to higher costs for producers and suppliers. These higher costs are often passed on to consumers in the form of higher prices. Secondly, increased demand for goods and services due to economic recovery. As economies recover from the pandemic, there is increased demand for goods and services, leading to higher prices. For example, as people start to travel again, there may be an increase in demand for hotel rooms, leading to higher prices. Similarly, as businesses reopen and hiring resumes, there may be increased demand for labour, leading to higher wages. These high wages can lead to increased consumer spending, further driving up prices for goods and services. Thirdly, rising commodity prices, such as oil and food. These play a significant role in determining inflation rates. An increase in the price of these commodities leads to higher inflation rates. For example, a rise in the price of oil can lead to higher prices for gasoline and other products made from petroleum, leading to higher inflation. Similarly, a drought or other weather event that reduces the supply of crops can lead to higher food prices and in turn, higher inflation. And fourthly, government spending and monetary policies. Governments can influence inflation through their spending and monetary policies. For example, if the government increases its spending and borrows more money, it can lead to higher inflation as the increased demand for goods and services drives up prices. Similarly, if the central bank reduces the interest rates, it can lead to higher inflation as it stimulates spending and increases demand for our goods and services. The central bank may also increase the money supply, which can lead to higher inflation if the increased money is not matched by an increase in the supply of goods and services. It is worth noting that inflation can have both positive and negative effects, and the causes of inflation can vary depending on the specific economic and political circumstances. However, in general, high and unexpected inflation can lead to uncertainty and unpredictability, making it difficult for individuals and businesses to plan for the future. So with that being said, why is high inflation considered bad? Well, in actual fact, high inflation can have several negative effects on an economy, including decreased purchasing power. Inflation reduces the value of money, making it harder for people to buy the same amount of goods and services as they could before. This means that people have less money to spend on other things, which can lead to a decrease in consumer spending and ultimately a slowdown in economic growth. For example, let's say that a loaf of bread costs around £2 and inflation is running at 2% per year. After a year, the loaf of bread will cost £2.04. So the same amount of money will only buy you 98 loaves of bread. This reduced purchasing power can have a significant impact on people's standards of living, especially for those on fixed incomes. Secondly, it creates uncertainty and unpredictability. This can make it difficult for people and businesses to plan for the future. For example, if inflation is running at 5% per year, it becomes more difficult for people to predict what the cost of living will be in the future. This can make it harder for people to make long-term financial plans, such as saving for retirement or buying a house. Additionally, it can make it more difficult for businesses to plan for the future too, as they may not know what the cost of inputs such as raw materials or labour will be in the future. This uncertainty can lead to reduced investment and economic growth overall. Thirdly, reduced savings. High inflation can erode the value of savings, as money saved today will be worth less in the future due to inflation. For example, if you have £100 in savings and inflation is running at 5%, the value of your savings will be worth £95 after a year. This means that people may be less likely to save, which can lead to reduced investment in the economy. And fifth, widening income inequality. High inflation can exacerbate income inequality, as those with fixed incomes, such as retirees, may not be able to keep pace with rising prices. On the other hand, those with variable incomes, such as business owners, may be able to benefit from high prices for their goods and services. This can lead to a widening income gap, which can be damaging to social stability and economic growth. It is important to remember that some inflation is normal and actually expected in an economy, as it can be a sign of economic growth and improved living standards. However, high and unexpected inflation, once again, can have significant negative effects, making it important for governments and central banks to work to keep inflation under control. So now we've introduced inflation, and we've given you a bit of background as to why inflation is considered bad. Let's go into more detail about each of the methods the UK government uses to try and control inflation. First up, monetary policy. The Bank of England is tasked with setting interest rates in order to keep inflation within a target range. By changing the interest rate, the Bank of England can influence consumer spending, borrowing, and investment, which can impact the level of inflation. For example, if inflation is above the target rate, the Bank of England may raise interest rates to reduce consumer spending and borrowing, which will slow down the economy and help to reduce inflation. Higher interest rates make it more expensive to borrow money, which can discourage people from taking out loans and spending money. Conversely, if inflation is below the target range, the Bank of England may lower interest rates in order to encourage borrowing and spending, which can help to boost inflation. Secondly, fiscal policy. The UK government can also use fiscal policy to control inflation. This includes measures such as adjusting government spending, increasing taxes, or reducing subsidies. By reducing government spending, the government can slow down the economy, which can help to reduce inflation. Similarly, by increasing taxes, the government can reduce consumer spending and borrowing, which can help to reduce inflation. Reducing subsidies to businesses can also help to reduce inflation by making it more expensive for businesses to produce goods and services. For example, if the UK government wants to reduce spending, it could cut back on spending on public services such as healthcare or education, which would reduce the amount of money circulating in the economy and help to reduce inflation. Conversely, if the government wants to boost the economy, it could increase spending on public services or provide subsidies to businesses, which would increase the amount of money in the economy and help to boost inflation. Thirdly, exchange rate policy. The UK government can also control inflation by adjusting the exchange rate of the pound. By devaluing the pound, the government can make its exports cheaper and more competitive on the international market, which can help to reduce inflation. Conversely, by strengthening the pound, the government can make its imports cheaper and reduce inflation. Number 4, supply side policies. The UK government can also use supply side policies to try to control inflation. This includes measures such as improving the efficiency of businesses, reducing regulation, and investing in infrastructure. By improving the supply side of the economy, the government can help to reduce inflation by increasing productivity and competitiveness. So, let's say the UK government wants to improve the efficiency of businesses. It could reduce regulation and red tape, making it easier for businesses to operate and produce goods and services, and overall, do more business. This can help to increase the supply of goods and services, which can help to reduce inflation. Conversely, once again, if the government wants to reduce the efficiency of businesses, it could increase regulation, making it more difficult for businesses to operate, which can help to reduce the supply of goods and services and boost inflation. Again, it is important to note that these methods are not mutually exclusive, and the UK government may use a combination of these policies to try to control inflation. Additionally, the effectiveness of these policies can be limited by factors such as global economic conditions and changes in consumer behaviour. So, in conclusion, Inflation is a key economic metric that measures the general increase in the price of goods and services over time. It is calculated as a percentage change in the Consumer Price Index in the UK. High rates of inflation can have negative consequences on the economy, such as reducing the purchasing power of consumers and reducing the competitiveness of the UK economy on the global market. There are a variety of factors that can contribute to high rates of inflation, including increased demand for goods and services, rising costs of production, and devaluation of the currency. The UK government uses a variety of methods to try to control inflation, including monetary policy, fiscal policy, exchange rate policy, and supply side policies. Monetary policy involves the Bank of England setting interest rates to influence consumer spending, borrowing, and investment. Fiscal policy involves adjusting government spending, increasing taxes, or reducing subsidies. Exchange rate policy involves adjusting the value of the pound. And lastly, supply side policies involve improving the efficiency of businesses and investing in the infrastructure around them. Not all of these methods may be effective in all cases, and the effectiveness of these policies could be limited by factors such as global economic conditions and changing consumer behaviour. Ultimately, the UK government must balance its goals of reducing inflation whilst also ensuring sustainable economic growth and stability. And once again, that's it. Thank you for watching and joining us. I've been the Midlands Investor. Don't forget to like and subscribe if you enjoyed this content, and I'll see you again next time.